From the morning reading, global stocks remain under pressure. EFA dropped below the 200-day moving average. Emerging markets, EEM, fall to two-year lows. New York Stock Exchange Composite Index still looks bearish. So do market breadth figures. Small caps lead, large caps lower. Deflationary trends weaken bond yields. As we go in a little bit deeper, EFA falls below the 200-day moving average. The trend in global stocks continues to weaken. As usually happens sooner or later, weakness in foreign markets is starting to weigh more heavily on the U.S. EFA falling below the 200-day average for the first time since early July. Most of us, today's selling is coming from Europe and Japan. Notice also that the May peak in the EFA stopped right at its June 2014 peak. That was an early sign that the rally in foreign developed stocks was stalling. Emerging market stocks look much worse. Let's go ahead and take a quick look at EFA, which the author of this morning reading has pointed out. There you go. And then on the emerging markets, and that's EEM, that's what the author is talking about here, and boy, that looks ugly. EEM fall to two-year low. Emerging markets threatening chart support formed late last year. EEM having fallen to the lowest level in 2 years. That's the most bearish signal in 4 years. Last week's devaluation of the Chinese yuan has intensified downside pressures in EM currencies, especially in Asia and markets that support commodities. The chart breakdown in the EEM threatens to put downside pressure in developed stock markets. The negative spread between emerging and developed markets is the worst since 2008 during the financial crisis. The negative spread between EEM and U.S. stock is the worst in 10 years. Something has to give one way or another. Emerging markets have to turn up, or developed stocks may start turning down. A lot of EEM selling is tied to a plunge in Chinese stocks. China is the biggest EEM holding at 24%. The New York Stock Exchange Composite Index leads the market lower. The New York Stock Exchange Composite Index trading well below its moving average lines after peaking during May. It found support along its March low, but not enough to reverse its downtrend. In fact, its sideways pattern that's formed since early July has a bearish look to it, a descending triangle. That increases the odds for another down leg. The New York Stock Exchange also includes all stocks traded on the New York Stock Exchange and is a much broader measure of the stock market than the large cap Dow or S&P 500 indices. The fact that the New York Stock Exchange is weaker than other stock indexes is reflective of deterioration in the broader market. That's also what falling breadth measures have been telling us. 2/3 of the big board stocks are in downtrends. It's not a good sign. Small caps, which is the Russell, weaken even more. Another sign of market weakness is seen in the relatively poor performance of small cap stocks. That's important because small caps usually peak before large caps, which is another sign of weak breadth. The RUT falling today after meeting resistance at its 200-day average. It's not a good sign when a previous support line turns into resistance. The RUT is also trading below its May low. The RUT SPX ratio has been falling since June and is threatening to drop below its early May low. That would be another negative sign for both the Russell and the S&P 500. And then finally, the S&P 500 retests the 200-day line. The S&P 500 large cap index, which is the SPX, threatening to drop below its 200-day average. It hasn't closed below the major support line since early July. The fact that smaller stocks are already trading below the 200-day line increases the odds the SPX could do the same. So does the fact that the New York Stock Exchange advanced decline line has been dropping since May and has fallen below its 200-day average for the first time since 2011, 4 years ago. That was also the last time stocks were in a downside correction. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:26 a.m. Central Time, and I'm recording this in preparation for the market day of August the 20th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, had quite a bit of material there from the morning reading, and none of it was positive. An awful lot of negative. Indeed, remember yesterday we were talking about how important this pattern was to confirm to the upside. Well, that failed miserably. And while we had this breakout, we had a false breakout to the bottom side, which was summarily rejected, and then a very strong breakout to the upside with a close outside of that coiling pattern. The following day, not surprising, a little bit of weakness to digest some of that move, and importantly, held the former resistance turn support and closed outside once again. But then, as has been the case so often in recent months, where we get some sort of move to an important resistance area, just immediately fail, and we can count over and over and over again where that has happened. Here we are right back into the triangle, and at this point we're so close to the apex. We've had two failures. Probably, in fact, I'm going to do it right now. I'm going to remove these drawings. I don't think that this coiling pattern has any kind of support for it at all anymore. Obviously, it's been ignored largely, and while it certainly seemed to have closing support, this one now has closing outside of that pattern, and clearly we've had breakouts on both sides recently. So really the coiling pattern seems to have broken down, and we'll have to see where we actually go within the larger range. The larger range, of course, would have a support area somewhere down here, and the question is where do we go from here? Obviously, from the FOMC yesterday, we had a lot of whipsaw back in action. There's no clear indication as to anybody having a significant take after that FOMC announcement. And indeed, here we have FOMC up right back to where we came from, retrace, and then close very weakly. So it's very hard to make any kind of definitive understanding from what the market was thinking about FOMC. It was just kind of all over the place. Let's go back to the daily. And of course the SPX was not alone. The Russell, very ugly again. IndyX, very ugly. And the Dow, very, very ugly. Now, in the overnight, and we'll get into the morning report, this is further broken down, and frankly, we know that now. And indeed, to take a look at our morning report, we have all four broad market indices down pretty significantly. At the time of this cut, the S&P was down over 15 points, or 0.75%. The Russell down about 0.5%. The NASDAQ and Dow also down about 0.75%. Crude oil continues to be hammered, and remember, this is on the new contract, the V as in victory contract, but it's down 1.36%. Euro up about 0.4%, bonds up about 0.2%, and gold up almost 1%. In terms of overseas action, also ugly there. China down about 3.5%, Hong Kong down nearly 2%, Japan down about 1%, Germany a little less than 1%, and the United Kingdom probably the best performing major market at down only about 0.4%. but weakness everywhere in all the broad market indices, both in the United States and overseas in the overnight action. Now today we do have our usual Thursday macroeconomic reports. We have the unemployment claims, we have Philly Fed manufacturing, we have existing home sales, and of course the natural gas storage if you're a trader in that market. Friday there wasn't anything for the United States, though there were a number of important euro especially reports, so kind of be aware of that depending on what markets you trade and how sensitive they are to those influences. In terms of volatility, you know, things have ticked up here in the last couple days, but they're still very, very temperate. In the big scheme of things, short-term VIX of 14.34, skewed just under the threshold of 125, where we start to pay more attention. IV percentiles 21, 32, 25, 35, all in the bottom third. You did have a standard deviation move put in by the Russell yesterday as well, but nothing really of particular interest, you know, in terms of recent or in a significant number of days going on there at this time. In terms of our regular daily report, we still remain IBD status uptrend under pressure. The accumulation distribution did change score a little bit, D minus and D. GMI index is at a 4 out of 6. So that author, I believe, continues to stay in cash. Our decision point scoreboards continue to have a lot of red arrows, so nothing here to kind of bring in hope for the bulls. Intermediate term market posture has turned bearish once again, and this thing has been flipping back and forth. So it's decidedly, ultimately neutral, strongly neutral. We had yesterday a slight bullish bias to that, but that broke down with yesterday's activity, and particularly with last night's activity. But the market posture is now bearish. S&P just barely above 50, and in real threat with today's action, if it's not summarily rejected, of going to severely bearish. Dow already severely bearish, NASDAQ severely bearish, as is the Russell. So you know, all those below a 50 level. Still at threshold level 1, we're still frankly strongly neutral, and the overall market stance at times seemingly somewhat bullish, at times seemingly somewhat more bearish, but still always within this range. And until that range breaks one side or another, you know, is certainly going to remain with this at least yellow light and breaks kind of cautionary stance. We did with yesterday's activity flag a couple new volatility based warnings, market and decline and sharp increase warnings, both fired off. The VIX daily squeeze is still present, but look at this distribution day count up again to a 10. So at some point you've got to probably elevate IBD status to confirm downtrend. But the problem is we've had all these distribution days all within a range, and so I'm not saying that I disagree, but with IBD's current status, because we are still inside the range, and I'm sure that's probably part of what's reflected in their status. But at the same time, this distribution day count is clearly not a healthy sign for the bulls. We have also New York Stock Exchange new highs, new lows was well over 300 on the new lows yesterday at 385. In terms of our risk aversion indicators, 4 out of 5 were risk off, and continues to be very weak signs. In our special opinions, no changes from yesterday. Very quickly, VIX is inside the acceptable window, but you got to consider the potential for increasing volatility. For both covered calls and put selling, conditions are really quite borderline for novice traders. Consider legging in to either type of strategy. Probably with covered calls, you want to put sell to leg into what you might want to covered call apply to. But bottom line is taking a very, very conservative stance, especially on the initiation of new positions, and both the way you enter, the amount of position size that you apply. The market just is not rewarding with any kind of follow through to the bullish side new positions at this time. In terms of sector-specific market postures, a lot more red here, obviously with the negative activity we've had in the last couple days, not very much holding up. Utilities clearly is holding up. If you're wanting to take outright bearish positions, then obviously materials and industrials and energy, especially energy and materials, continue to just be very, very quick to turn negative at every downturn. And you see only utilities here holding up across multiple time frames, and of course that is by its nature very, very defensive. So that's not a good sign for the bulls that utilities are doing well. The other thing that is, before you just go all pile into utilities, remember that in the big scheme of things, we're likely to have continued unraveling of interest rates, and these utilities who have very heavy debt loads and are very sensitive to the impact of increasing interest rates could all of a sudden turn quite ugly. Remember, utilities did very well last year and then came into this year, and as people were starting to unwind and you saw the long bond start to unwind in anticipation of those interest rate hikes, the utilities had a significant correction and more recently started to bounce from that correction area, but that's not likely to hold. If interest rates become the subject of the day, you'll likely see utilities start to unravel. So that's probably enough for today. We had a lot on the morning reading and other significant inputs. As always, if you find what you're hearing here is helpful to your tradings, we greatly appreciate you sharing with your Twitter followers by retweeting us, and the same thing with Stock Twits, liking us on YouTube, subscribing to us on the YouTube channel. All these kinds of things can be, certainly reinforcement to us to continue to provide for this free market opinion and commentary. Feedback is always welcome at support@falconglobaltraders.com. More information about how we apply these principles is available at this website. Disclaimers as always, hit the pause button to review if you need more time. And we look forward to seeing you back here tomorrow morning before the market opens with the market preview. Good trading.